Well, according to some historians, it began with goldsmiths. These were individuals who were dealing with gold for various purposes. And they instituted the practice of taking deposits of gold from customers because this was a matter of safety. The customer didn't want this gold in his house. The customer didn't want this gold on his person. He would deposit it with the goldsmith, and the goldsmith would give him some receipt for this. And according to these historians, the goldsmiths soon found out that the depositors didn't all come back at once for their gold. Some of them came back to get the gold. Some other depositors came in. So the goldsmiths only needed to keep a fractional reserve of the gold in their possession to meet the depositors who came back for redemption of their receipts. And this enabled the goldsmiths to do what? To issue more receipts than they actually had gold, because they were being paid for these receipts. Well, this became the fractional reserve practice, and the banks picked up on this as well. So a bank might receive, let's say, $100 in gold, and its fractional reserve was 1/5. Through practice, it realized that it only had to keep 1/5 of its reserve to meet depositors who were coming back to redeem their accounts. What would it do with the other 4/5, the other $80? It would loan that to somebody else at interest. So the bank was making a profit on this deposited gold, and it wasn't worried that that gold had already been lent out to someone else, because it knew that only 20% of the depositors would come by on a regular basis to redeem their deposits. Now, the problem arose when something happened in the marketplace and the depositors now either needed the money themselves, or they became suspicious of the practices of the bank, and they wanted to get that gold out before the bank perhaps went into bankruptcy. And now the banks had to meet this increased demand for redemption, and it might go very quickly above the 20% or the 30% that they actually kept as their reserve. They were caught in a problem because they tended to have lent that gold for a long-term process. It wasn't lent for a day or a week. It was lent for months or perhaps years. And now the banks found themselves in a really stringent position because there was an immediate demand for their deposits, because those people had redemption on demand, whereas the banks could not call in those loans unless the loans had been specifically written that way to get those loans paid off immediately. And then you had what was typically called a stringency and a banking collapse